Hi friends, today we are going to discuss under business combination what will be the treatment of goodwill outstanding in acquirer's existing financial statements and identification of acquirer if combination happens through creation of new legal entity. Let's see. Goodwill already existing in the books of acquiree is ignored while considering the fair valuation of assets. India's 103 allows to consider only the fair valuation of identifiable assets and assumed liabilities, and difference between the purchase consideration and fair valuation of net asset is accounted as goodwill or gain on bargain purchase under the head capital reserve through other comprehensive income of the entity. Can we consider the goodwill? If yes, then what will be the accounting treatment? Let's see with the help of one example. Company A acquires assets of Company B under business combination for purchase consideration of 1000, and the assets of Company B are valued at 1450, which includes 250 for goodwill. In the books of acquire, assets will be counted at 1200, which is fair valuation as on acquisition date, and 200 as capital reserve, which is gain on bargain purchase through other comprehensive income. If goodwill is also accounted in the books of entity, then capital reserve will increase by the goodwill amount, and in the financial statement, capital reserve has to be adjusted against goodwill. Ultimately, results will be same. Sometimes business combination happens through creation of new legal entity. A new legal entity is formed to acquire the assets of existing companies. In such specific cases, acquirer is identified basis the manner of consideration is paid by the new legal entity. Consideration can be made through issue of equity instruments, or consideration can be made by paying in cash. Who will be the acquirer in such cases? Let's understand with example. A new legal entity X is created to give effect combination between Y and Z, which are the existing legal entities, and consideration is paid through issue of shares to Y and Z in the ratio of 75 and 25. In this case, Y is the acquirer under business combination arrangement on the basis of voting rights, and assets of the Y will remain at carrying value, but assets of the Z will be fair valued. If consideration is paid in cash or through transfer of other assets by entity X, then entity X will be identified as acquirer, and assets of Y and Z will be fair valued in the financial statements of combined entities on the acquisition date.